If you're an employee that is awarded stock through your compensation arrangement, or you're just an individual that invested in a stock and you hit a home run in terms of performance, you may find yourself in a position where you have a single stock that's making up a considerable portion of your net worth. This is known as having a concentrated stock position. And people will ask me from time to time, is there a way to get away from having that concentrated stock position without triggering too much tax? A couple different strategies to consider. The first would be just incrementally selling those shares over a longer period of time. Another thing that you might want to look at while you're doing this is the cost basis of each of those lots of shares. If you find the ones that have a higher cost basis, you can sell those first and guarantee that you're going to lessen the gain on those shares versus the ones that have a lower cost basis. Another strategy to consider if you're charitably inclined would be to gift the stock directly to charity. A lot of people think that they have to sell the stock first and then gift cash to charity. But by gifting the stock directly, you're able to avoid any sort of tax from the sale of the stock, and you might even get a tax deduction by gifting to a charity. In terms of gifting, you may also want to think about gifting stock directly to children. It's a great way to give to your children, diversify your portfolio. But one thing to consider is if your children sell the stock down the line, they are ultimately going to have to pay the tax on that gain. Another strategy to consider would be for those that have money in a 401k plan is a net unrealized appreciation strategy, or NUA for short. Basically, when a triggering event occurs, most of the time it's just retirement. You have the ability to move company stock out of a 401k plan, pay ordinary income tax on the cost basis of that stock. But eventually, when you sell the stock, any gain on it will be paid at capital gains rates, which are typically going to be lower than ordinary income brackets. So you're going to want to keep all of these different items in mind when you're looking at concentrated stock positions. But I would always consult your accountant and your advisor to make sure that you know what the tax effects are going to be before you pull the trigger on any of these strategies.